Well, a stock that's been a multi-bagger, 12 months 4x and 24 months nearly 6x. It's REC we're talking about, and we'll try to break it down. What should one look out for in terms of this stock? First off, why has this happened? Consistency of profits. It was already pretty severely undervalued. It was valued at almost 0.4 times book at its bottom, which is extremely undervalued. And growth has come back in a big way, largely because the power sector has come back in a big way. So those are the three levers that's helping it grow. In terms of its last 5 years, what it's done, it's grown its loan book at 13% compounded from 2.7 lakh crore. It's coming now at 5 lakh crore, the loan book. Total income going up in a very similar trajectory. But here's the kicker. OPEX is extremely low, and therefore profit after tax has compounded at 20%. That's quite solid. And the net worth has gone up by 15%. This is a company which used to give dividend yields worth 15% when its price to book was 0.4. So it was extremely undervalued and gives a very high dividend yield as well. Now, where are we at? Both price to earnings as well as price to book, we are at decadal highs, and dividend yield is at decadal lows. And therefore, maybe time to be cautious. In terms of commentary though, very, very positive. They're expecting recoveries worth 2,000 crore in FY25 itself. They're expecting to double the balance sheet latest by FY30, maybe even as close as FY28. They're expecting PAT growth of roughly 23 to 24%, which means that profit after tax from 14,000 crore will go beyond 40,000 crore. Currently, the top 10 companies in India in terms of profitability don't make 40,000 crore. Maybe a few of them don't. So therefore, this is fairly large in terms of its guidance. Your net NPAs will become nil by FY25 itself, and they will not require any equity fundraise to fund all the growth that they are accounting for. But valuations are high, and there are certain regulatory risks with regard to project financing which have come out today. Outside of that, it looks like the commentary is quite solid, but take care of risks because valuations have run up.